The other profile that we see is the investor who has maybe owned smaller forms of single family residential or commercial real estate. I don't want to manage this real estate directly anymore. I'm tired of getting the midnight calls, right, when things break. And they're deciding that it's time for them to liquidate 2 or 3 of them and then diversify those proceeds into passive investments, right?
Welcome to the Real Estate and Financial Independence Podcast. My name is Chad Carson. I'm your host for the show. You can also call me Coach, and this is a show all about helping you get out of the financial grind so that you can do more of what matters. Whether you're a brand new listener or a longtime listener, it's an honor to have you here listening to another episode. The title of today's episode is How to Invest Passively in Commercial Real Estate Using a Platform Called CrowdStreet. Now, if you've been paying attention to the episode titles lately, you might have noticed a sprinkling of topics over the last couple of months having to do with syndication investing. So this is a type of investing where you, as the person putting up the money, are investing in other people's deals, and typically in a more passive role. So you have to screen the deals up front, but then you invest in other operators who are buying multifamily properties, often larger commercial properties, and then you benefit from that and get a piece of that as the passive money partner investor. Well, this is another example of me doing my own research. So hopefully this is also helpful for you, but this is something I'm expanding my own investing in. I invest most of my active kind of direct investments in Clemson, South Carolina, but my business partner and I are considering geographically diversifying and getting into other deals. And one way to do that is syndication investing. And so one that's been on the top of my list that I'm very interested in and been impressed with is called CrowdStreet. It's a technology platform, a crowdfunding platform that matches up deals, almost like a marketplace, with people who are trying to invest in these deals. And so I wanted to get the chief investment officer for CrowdStreet, Ian Formigle, who I've been very impressed with, listening to him on other podcast interviews, to sort of give me the fundamentals of how does this work investing on CrowdStreet platform, and what do you need to look for? How do you evaluate people who are putting deals together, who are what are called syndicators? How do you evaluate the types of deals themselves? What kind of things does CrowdStreet look for, and what should we be looking for when we're investing in other people's deals? And then also, what big picture trends are affecting the market. This is a market that's changing. Both interest rates are low. There's people talking all the time about, what is this, a market bubble? What's happening right now? And so I really enjoy listening to professionals like Ian talk about the fundamentals of what make good real estate good. And he gives some helpful insights on that in today's episode, in addition to all the other conversation about how to buy passive investments. Just a little bit about Ian before we get started. Ian's a real estate professional and a serial entrepreneur. He's had 25 plus years of experience in different types of real estate investing. He's had his own personal portfolio of single family houses, but then also got into private equity, into startups, into investing all over the country with different types of investing. So he's kind of gone bigger with his investing and ultimately landed at CrowdStreet, where he's the key decision maker for all of the investments that get onto the marketplace. Ian is also the author of the Comprehensive Guide to Commercial Real Estate Investing, and he's a contributing author at Forbes.com. Now, before we get to the interview, it's time for my weekly behind the scenes segment where I share a short snippet of what's going on with me and my real estate investing business, my finances, or my business behind the scenes. And this week, I want to talk about a topic that doesn't get a lot of attention, but it should, called bookkeeping. Y'all have probably heard of what bookkeeping is, but as a real estate investor, whether you're a tiny real estate investor with just one property or a few properties, or whether you're getting a lot bigger, bookkeeping is kind of the nuts and bolts of behind the scenes, paying attention to the numbers. And so I wanted to share a little bit about what I do with bookkeeping. Let me know by emailing me at podcast@coachcarson.com if you'd like me to do more of a long, in-depth topic on this. Maybe I could do an episode or two on how I run my bookkeeping behind the scenes. But just a quick view of it, I use QuickBooks. My business partner and I have been doing that for almost 19 years. The entire time we've been investing, we use a software called QuickBooks. It's a really versatile software. It takes a little bit of time to learn it and get up to speed, but people use it for all sorts of different businesses. You can also use it very well for real estate investing. We use the desktop version of it. There's also a cloud-based version you can use on different computers, just something we've been doing for a while. And the point though, whatever software you do use, I like QuickBooks. I think it's very versatile. The main point is you have to do it regularly. I have noticed, I've had the opportunity to see behind the scenes of a lot of real estate investors' businesses. And I've noticed the trend is that if you meet people at a meetup, other real estate investors, they talk all about the numbers and they talk about, this is how much money I made on this deal. This is how much cash flow I'm making. Behind the scenes, 8 or 9 out of 10 don't really have a great idea up to that moment of what's going on in their business. They don't really have a good grasp of the numbers. And the way you do that is by keeping a good set of books. So this is tracking all of your transactions. Every time you spend money, paying attention to that and categorizing it correctly. And every time you receive money, also doing the same thing, categorizing it, for example, by property. If you have 5 properties, in QuickBooks, you can use something called class accounting, where you can basically put a label on it that says this, all the income from this property. When you have a deposit, for example, you would classify it as property 1. And then you get another deposit, classify that as property 2. And you do the same thing with expenses. And the payoff of all that, what can seem like pretty detailed work, is that you can run reports and that show you how much money you're making on a monthly basis, on a per property basis, all the way back. If you've noticed some of my YouTube videos that I do, I go all the way back to the very beginning of when I bought that property, and I can show you a spreadsheet of exactly how much money I've made, how much money I spent from year to year, and ultimately how much money we made in the end. And it allows me to make better investment decisions, both in real time and in the future. So that's the benefit of bookkeeping. It's not a sexy topic. It's not something that's always fun when you're doing it. I kind of find it like washing the dishes, where, when you have this big pile of dishes, that's not fun to have to go through them. But when you get done and you have that satisfaction that it's all clean and put in place, at least if you're weird like me, that can give you some satisfaction. But the biggest satisfaction is the confidence you get. I almost compare it to like the Matrix, Nemo, or was it Nemo? Yeah, Nemo in the Matrix, when he finally slowed things down. And in that movie where like he could see like the zeros and ones inside the Matrix, that's kind of like what having good books are. You can see everything in your business as numbers, and you can tell when things are going well. You can tell when they're not going well, but it all starts with a habit of using that. So that's my little pitch for you to get on top of your bookkeeping. Use QuickBooks or some other tool that'll help you do that. And I'll be sure to give more content in the future, but let me know at podcast@coachcarson.com if that's specifically a topic you'd like to hear more of. If you want to connect with me even more behind the scenes and hear stories like this or tips like this, there are 2 great ways that you can do that. The first is to get on my free email newsletter, which comes out each Monday and Friday. And you can register at coachcarson.com/REI toolkit. New subscribers to the newsletter get my real estate investing toolkit, which includes helpful tools like my closing checklist, a deal worksheet, a tenant screening criteria checklist, and other goodies. Again, you can get it for free at coachcarson.com/REI toolkit. The second way you can stay in touch with me behind the scenes is that I teach online courses where you can interact with me and let me help you with your own real estate investing. Some courses are available anytime on topics like creative financing, finding off-market deals, due diligence, and more. And then I have my premier course, which is actually just wrapping up as a 10-week course called Real Estate Deal School. And I open it up each spring and each fall at the moment. And students go through that live with me, and I help you step by step to purchase your next investment property. You can get details on all those courses at coachcarson.com/courses. Now let's get started with today's interview with Ian Formigle. Hey, Ian, welcome to the podcast. Thanks for being here.
Chad, thanks for having me on the show. It's a pleasure to be here.
Yeah, I've been looking forward to this, and I want to get into some of the fundamentals. A lot of I've listened to some podcasts with you, and I feel like you're a great teacher of this real estate in general and the fundamentals. And I want to get into commercial real estate. I know a lot of people in our audience invest in smaller residential properties, but there's a case to be made for diversifying and getting into more other types of investment strategies. But I thought it'd be good just so people get more familiar with you. Would you mind telling a little bit about your background with real estate? Like what got you into this in the first place? You've been doing it for 25 years now, I believe. So what was the starting story for you?
Sure. No, happy to do so. So, my journey through my career has always been in investments in some way, shape, or form. I originally started off as a derivatives trader, kind of on the financial side. So I was an equity options market maker. I did that for a number of years, but I'd always grown up in a real estate family. So, a family that had owned and operated single family rentals as well as small multifamily properties. So it was a pretty easy jump after an initial career in the security side, wanting to figure out what was it going to be the next thing in my career. I decided to go towards real estate. And I started like most other investors started. I started buying single family homes and managing them and renting them and improving them and ultimately selling them. And it was through that experience of doing that for a number of years that I transitioned into multifamily investing. And that's actually when I became a multifamily syndicator. So after kind of some initial success on the single family side, and then looking for literally where we were going to, defer gains and do 1031 exchanges in the early 2000s, decided to pivot into multifamily investing. And it was at that point where I kind of took a top-down approach to say, well, let's go invest where investing makes sense, not just necessarily where my backyard is. And so I kind of put together a rudimentary model in terms of that looked at markets and looked at asset types and kind of market fundamentals and things like cap rates and rent growth. And then also looked at some quality of life measures. And so out of that, it decided that the data was telling me in the early 2000s to go invest in Birmingham, Alabama. And so I live on the West Coast, and so that was a stretch, but it was an interesting experience. And I actually got some feedback from some people that had exposure to Birmingham and some other forms of elements. One was a friend of mine who was a band manager for a couple of really large popular bands, nationwide names that you'd know. And so, when I approached him with hey, I got this thesis about investing in Birmingham, Alabama, he's like, hey, Birmingham's great. We sell shows out there. Really cool environment, kind of told me about a couple markets, submarkets he particularly liked, one of which was where I was going to invest. So that kind of launched my multifamily investing career. Did that for a number of years. And then kind of fast forwarding into the, coming in the downturn, I had stopped syndicating deals. People didn't really want to syndicate deals in 2009. I had acquired mostly Class C and B garden style deals. I had acquired mostly Class B and C garden style deals located in places like as well as Alabama, but Texas and Oklahoma and Kentucky. So things were going okay, but we were hanging in there. But I was really at that point, I wanted to take the next step in the career in my career path and go towards commercial, true commercial real estate private equity. I was then able to join a group based in my then hometown, Portland, Oregon, to go into what we call GPLP acquisition format. I joined a group who had done about at that time maybe $4 to $5 billion worth of total cap in things like office, industrial, and retail around the Western United States. Total size of those deals would run from roughly 25 million to maybe 150 million. And so then I became a senior acquisitions officer to go out and find good deals across the Western United States and then pair those with institutional capital, a lot of household names that we would partner with, and then, and affect value add business plans. So I did that for roughly 4 years or so. And then the co-founders of Crowdstreet approached me in 2014, around the middle of the year, about the possibility of joining them to help really kind of launch their marketplace and grow a company. So I had the fortune to do some initial homework on the space through the lens of real estate private equity, from the place where I currently was, and just kind of, I guess, so to speak, I drank the Kool-Aid over that 6-month period. And so when the co-founders approached me about being kind of an original kind of founding executive with another gentleman who had joined a month or two before, it made abundant sense. So I joined that group, became the CIO of Crowdstreet, have been serving that role ever since. And so fortunately, we've been able to scale our company. Started with a few people in the back of an office somewhere and getting our first revenue in the door. And now we're eclipsing, I think, about 200 employees. And in 2021, we'll fund well over $1 billion of equity into commercial real estate projects all across the country and have relationships now with probably 250 plus operators and developers all over the US. So it's been a fun journey, and that brings me up to the present.
Yeah, it's an amazing journey. I think it's talking about my own journey. I've started off in single family house investing, similar to, it sounds like what you did with your real estate career, and have bought some smaller multifamily properties. But I want to go back to Crowdstreet. It's really stood out to me in Crowdstreet, but then more generally crowdfunding, and this idea that more smaller investors or more individual investors can get into this domain that a lot of previously only institutional or maybe very wealthy investors got into. And I think it'd be just a good time to, since you've done both, and I'm actually interested and have had my eye on doing more syndication deals as a passive investor as well, just to talk about from your standpoint, what are some of the differences, maybe pluses and minuses for people doing small scale investing, which a lot of our audience will do, but then also considering buying into and getting more diversification with more commercial type investments, particularly through crowdfunding?
Yeah. So good question. And I think to begin is to probably draw some differences between what either small scale syndication or even just simply acquiring your own small properties looks like and feels like relative to what we're doing on the Crowdstreet marketplace. And where I begin is the imagine that if you want to, as an individual, have the experience of owning, running, and, being, the master of your own destiny in an asset, and have that journey of what it's like to buy real estate, what it's like to operate it, and then ultimately sell it. And along that way, hopefully, affect a business plan. Then doing your own deals is a great path. I mean, again, I've done my own deals over the years, and that's the thing though. You are buying and operating your own real estate, right? You're making the decisions. The deal is going to make it or break it, based upon what you were able to do with it. And success is really, it's on you, and it is, what you are able to bring to the asset, from a perspective of like what kind of financing you can bring, right? What kind of relationships you have out there, what does your balance sheet look like, and what is your ability to, navigate real estate through what could be through choppy waters. And so those individuals who feel most comfortable, kind of like staying small or smaller, but having that direct control and being the operator or developer, then doing your own deals is a great path. What is fundamentally different about what that perspective and that experience relative to what goes on in the CrowdStreet marketplace is the control. What investors are coming to on the CrowdStreet marketplace for is the opportunity to invest passively in syndications at scale with, proven operators and developers around the country, right? It's really at the point when they say, I don't want to be the person, right, driving this boat. I want to get on a boat that I like, and I want to allow another group to make decisions on operating and developing commercial real estate. It's at that point where it makes sense for those individuals to participate. And it's also fair to say that some individuals do both. I mean, we've seen tons of investors come onto the platform who have their own portfolio. That portfolio could look like single family rentals. It could look like small multifamily. It could look like small scale commercial. And they're looking for diversification to say, I don't want to be, always making all the decisions. And probably really importantly, they don't necessarily want to or have the ability to invest in some markets that they really see opportunity. Maybe they live in Phoenix, Arizona, for example, and they say, I'm really good. If it comes to Phoenix, I know block by block. I know where I would invest. I know how to invest, but I really want to invest in Austin, or I really want to invest in Nashville. I just don't have that particular expertise assembled in-house to go take down and execute a business plan in Nashville, but I would really like to invest there. So I think I should probably go passively rather than actively, because if I went actively, maybe I'm not going to get access to the best deal flow. I'll get access to the deal flow that I can get to. Maybe that's been picked over. Maybe there's a reason why it's coming to me. And so maybe I should think through, is it really best for me to make that active plunge? For some groups it can be fine. But for other groups, they've kind of decided to take a passive format. And then it's at that point that kind of the applicability of our marketplace comes in, because in that scenario, we are going to partner with the groups that are known and proven and really know how to get after the best deals in Nashville, get those first looks. And as we know, real estate, it's an inefficient market, right? It's not fair and it's not equal. And so sometimes if you can't beat them, you join them. So that's the key difference between whether you buy it or operate it yourself, or whether you decide to partner and invest passively with somebody in a deal on our marketplace.
Great explanation. And just to give people a little bit of a history, because you've touched on a little bit of this crowdfunding idea, but I just want to differentiate the way it used to be with some of these syndication type deals, because there's been syndications going on for a long time, and people could go and invest as a limited partner in somebody else's deal. But what makes today's time different for an individual investor than 50 years ago, for example?
Yeah, that's a great question. And that actually goes right back to the beginning of CrowdStreet, because in 2013, Title II of the Jobs Act, which stands for the Jumpstart Our Business Startups Act, went live. Jobs Act was passed in 2012. In Title II, what it enabled for the first time since really like the Securities Act of 1933 was the basically the general dissemination, or what we basically say like advertising, of a private equity Reg D deal. Now, the syndication that had been occurring, prior to and up until that point, really was that country club model. It was conducted under Reg D. The exemption was called 506B, still called 506B. And really what that meant was deals were private and relationships come first. So you needed to get to know a group. You needed to understand who they were, and they needed to understand who you were. And once you had that relationship established, they could give you a look in a private deal. So in essence, we kind of say relationship first, deal second. Now, what changed at the end of 2013 was 506C became possible. And what that enabled was, assuming that 100% of the investors in that syndicate were all accredited, and they had to be verified as accredited, you could do a couple things. First, you could flip the order of operations. You could do deal first, relationship second. That's where that accreditation factor comes in and verification. And then second, you could generally solicit. You could put it on, that means you could put it on a website, right? And then that's where CrowdStreet came in, because what we looked at was, hey, if you can take commercial real estate, put it online, you can advertise it. Now we could bring scale to it. And that was the other aspect of what 506C did that was different from before, is that it enabled up to 2,000 individual investors to go into one single deal. So as we looked at it, we said, look, as long as, and real estate is capital intensive. So as long as we could group together large numbers of investors, which could really only be possible through technology, you had to kind of take the e-commerce approach to real estate investing. Well, then if we could really assemble thousands, 1,000 plus up to 2,000 investors, well, we could raise up to $100 million in one syndicate. That just hadn't really been possible before, right? If you went around the country and said, hey, syndicators, can you wrap your head around a $50 to $100 million syndicate? Most would say no, because they just didn't even have that kind of Rolodex available to them. And two, they just didn't really understand how they could wrap their head around that many individual investors. Or if there were, they would have to write big checks, right? And so it's just like that amount of money. So we were thinking from the perspective of saying, scaling size through technology at reasonable investment increments, which on our marketplace equate to about $50,000 per investment today, could give us the ability to actually assemble massive amounts of capital in one deal. Real estate's capital intensive. Great deals around the country can be expensive. They can be over $100 million, but we could actually participate in them. We could actually be the driving force behind that equity. And that was the vision. So we set out to do that in 2014. We obviously started off with humble means. We did 4 deals and raised $5 million that year. But today we are actually hitting to the rate where, we're seeing $35 million as possible in a single syndicate. It comes through that journey of getting to scaling the investors around the country and then building the platform that enables that scale. So that's really what's different about what we do relative to standard syndication, is it's massive amounts of people coming together in an online arena through an online process, and then grouping together larger sums of money to take down now what is competitive with large institutions all around the US.
So from that operator, there's kind of two sides to this equation that CrowdStreet is changing, is that the person who's putting a deal together now has access to capital that they didn't have before. They didn't have that Rolodex, or they didn't have a large enough Rolodex to put a $30 or $40 million deal together. Whereas now, through relatively smaller pieces from many more people, they can get the money to do their deal. They can make more money. And then so flipping back to the other side, us as the investor who could potentially invest in this, we're having access to deals. If we're in South Carolina and we want to invest in Arizona, maybe we had no clue about how to invest with that person or that type of deal. Now there's a marketplace for it, and we can now connect with them. So really an expanded pie almost. Like this is just new on both ends of the spectrum.
Yep. And a really important point to draw out, and this is a common question we get asked, so just to address it straight on, is that, today we work with groups all over the country that have lots of capital sources available to them, right? Capital can be somewhat abundant in today's market. And so there's been this misnomer out there of, adverse selection, right? You must be getting the worst deals because why are they coming to you? And so what we've always explained over the years is that this is a form and type of capital that is new, it's emerging, and it's growing rapidly, right? We've been doubling practically every year since inception. And so you go to those groups and say, well, look, this is the equivalent of e-commerce. And now we probably call it we're around the late 90s in e-commerce. And if you would fast forward today and you said, well, back then, would you want if you were a retailer, would you want a website? Would you want e-commerce as part of the way that you sell things? I think the answer is abundantly yes. So it's that mindset of saying what we really are doing here is we are bringing an e-commerce element to commercial real estate investing. It's starting and it's growing rapidly, so therefore it's not going away. And particular in why I think really around the thesis of like why these groups really do look for this and see this as potentially a superior form of capital is the ability around, and what we are seeking on our side is groups that we can fundamentally trust and we can invest passively with them, right? A lot of capital out there, a lot of institutional capital in particular, it comes with a lot of strings, comes with a lot of conditions, and it comes with, very tepid in terms of how much control you really get, right? If sometimes, and I know this from my background as a GP, sometimes you do that deal with a large institutional LP, and 6 months later, you're like thinking, I think this is their deal now. It's not really even my deal anymore. Yeah. I think I've been given some, a short leash to go execute, but if something goes wrong, they're looking to put a different group in. Our capital is entirely different, right? It is predicated first and foremost on the relationship and strength of that operator. CrowdStreet's not looking to take control of a deal. The investors within the syndicate are not looking to take control. So we have to fundamentally believe in that group's ability to execute, as well as their vision for how they think they're going to achieve success. So we might bring today $30 or $40 million to a deal that is from the outset looking for that passivity. Now, on our side, the reason that we can all, as investors, get comfortable with the passivity is because the investors on the marketplace are now looking at a diversified investment situation, right? Portfolio. By investing $50,000 at a time, a lot of the investors on the marketplace are seeking to invest $500,000 or more in total. So when they do those 10, maybe going to 12 or 13 investments, they're looking at from the perspective of saying, I'm ultimately investing first and foremost with that group. I'm going to trust that group, and I'm going to accept the outcome. And by investing in 12 or 13 deals, I'm probably going to bet that one of these outcomes is not going to be great. 2 might be lackluster, but okay. Another handful are going to be good, and then the remainder are going to be great. And I'm going to blend my way to, kind of like roughly pro forma, or maybe better than pro forma returns, but I'm going to do it through that diversification. They're willing to give up that control because they're kind of playing the diversification game. When you're an institution and you put 40 or 50 or $100 million into one deal, where that capital comes from, they have to have control because that capital is coming from pensions. The pensions are allocating to the managers saying, you must have control in order to spend my pension money. And so then the pension manager is then putting it into a deal saying, I must have control because the only way I got the capital is because the pension is saying I have to have control. So there's this element of control that goes into institutional capital that we're looking to kind of break down. But by doing it by scale, if we could do that, we can actually get to better deals. Ultimately, once we can get to the size of going toe to toe those institutions, because the best groups out there, they don't want to cede that control. So that's kind of like, that's the nexus of where we come in.
Yeah, that makes a lot of sense. And I can see the value add all around there and why that's really can change things. So I want to dig into the individual investor who's making these decisions to invest on there. I want to get into some of the fundamentals, which I know CrowdStreet does such a great job of teaching about how do you choose which ones to invest in. But there's one term that I want to make sure everybody understands because it's an important part of who can and can't invest on there is the accredited investor terminology and what that, can you explain just a little bit about that just so people understand who can and can't invest in these types of deals?
Of course. Accredited is an SEC defined term. It's not something that CrowdStreet made up. It's just something that we have to live by. And that definition really boils down to the following. If an individual earns $200,000 per year as an individual, and they're an individual household, or they're part of a joint household and they earn $300,000 per year, they are accredited. Alternatively, if that individual is part of a household or an individual that has $1 million of net worth exclusive of their personal residence, the joint entity has to meet one of those two criteria in order to meet the definition of an accredited investor per the SEC terms. That is the criteria by which that we determine eligibility for the marketplace. Any investor that goes through a deal on our marketplace is ultimately going to have to provide a credential, something either provided by an online source of which we have a relationship with, or provided by their own wealth manager, attorney, or accountant that attests to their eligibility. That credential is renewed every 90 days from when it was last issued. So if you did a deal and it's been 6 months, then you're going to have to go through a reaccreditation process. The overall process, by going through an online source such as CrowdStreet, doesn't make necessarily mean it's onerous, but it just does mean that it's going to take a day or two to submit the paperwork and go through either the online process or just simply upload your updated letter from your accountant, and you're good to go. But that is the criteria by which you have to generally solicited Reg D deal anywhere around the country, whether it's us or somebody else.
Thanks for explaining that. And so for someone who does not meet that, if you made $150,000 per year, there are other options out there, obviously investing directly in real estate and maybe going to more other larger scale options. Yeah, I'm thinking public REITs, things like that. There's just not particularly buying on a marketplace where you're buying these syndicated deals. That's where that exclusion comes in.
That is correct. And it's fair to point out that, one of the key things that's going on our marketplace and why investors are coming is for that ability to invest as a limited partner in a partnership. These are K1s that are being delivered at the end of the year. They're not 1099s. So there's a little bit of a sense of sophistication in terms of what that means. You have to be willing, in often cases, what that really means is you have to be willing to defer your tax reporting, because getting a K1 in your hand by April 1st, it happens on our marketplace, but there's certain groups who've just fundamentally said, we deliver K1s in June or July. And so, but the investors are looking for that K1 on our marketplace, because if you invest in that format, you get the benefit of depreciation in the partnership. So you can get passive losses while you're getting actually cash flow distributions. And so it is the most tax advantaged way to invest passively. And the investors on the marketplace abundantly get that. And that's part of the key criteria why they come here and get passive income in my pocket that ultimately translates into a long-term capital gains.
Got it. All right. So I think we understand like what the lay of the land is there, the benefits of doing this. If you're a passive syndicate investor, you're getting access to deals you might not get otherwise. You're also able to diversify your portfolio. Lots of benefits here. And so I want to talk about something of how do you filter out what deals you're going to invest in? You mentioned first and foremost that you have to find an operator or somebody you trust. And I think for a lot of investors, we understandably are kind of control sensitive. Like, all right, I'm going to control this investment and do it myself because I feel like I can trust myself. How do you? Let's start with just the operator side of things. You've been an operator. You're now on the investor side of things. What are some of the key things that we need to look for when we're choosing who to invest our money with, who's going to be operating that investment?
So evaluating deal flow on the marketplace typically has to go through 3 major steps in order to get to, we determine that a deal is eligible for debuting on the marketplace. The first is the part of the evaluation of the sponsor itself. So prior to getting into the specifics of a particular deal, we're going to spend a lot of time at CrowdStreet amongst our investments team vetting that sponsor and going through kind of a deep dive in terms of who they are, what they do, how long they've been doing it, and how well we think they can do it going forward. And so that is going to take the form of things like evaluating their track record. And really we're going to ask questions. And what's interesting is that, when you get into the questions, I think is really where the crux of knowing if you have a good group or not comes out. Because when you walk through a particular scenario, a deal, so we'll look at their track record and we'll say, let's just go do a deep dive on a couple of these deals and walk us through the business plan. What did you see? What did you do? How did it go? What went wrong? What did you learn? How did you exit? And why did you get in? Why did you get out? And when you get into that case study scenario and analysis, you really can't make up a good deal out of what would be a bad deal. You can't, like, when you get into the specifics, the nuts and bolts of it, this is what we found. And we thought we were going to rent for X and we couldn't rent for X. And this is what we had to do. You almost literally want to hear from that group what they learned, how they were proven wrong in a particular part of the deal, how they were proven right in other parts of it, but then what they did, how they managed through the process, and how they ultimately sought to exit and deliver investor returns. And if you answer those questions and you get answers that sound vague, or they go too high level, and they don't literally get down to nitty gritty, nuts and bolts of how they did it, that's when you notice pause and potentially walk away. because that stuff is very nuanced. It's very specific. It's very deep. And a good group will have lived with that deal and knows every bit about it and knows why it was great or why it was bad or why it was in between. So I begin with there just point out like that interview process is really fundamental. You look for that first. Like that's a really key thing to look for, because we have to conduct background checks on them. We use software that helps us do that, called Thomson Reuters Clear. We have to get to essentially knowing that the group is, has a good reputation in the marketplace. There's no bad actors involved. There's really no skeletons in the closet. And also through that process, it's fair to also uncover maybe, something that happened bad in their past, particularly for groups that operated through the GFC, because if you did, you pretty much have something that went wrong along the way. And again, so an honest and, explanation of what occurred at the time, how you managed through it, is also really important to understanding the story of the sponsor. And we're looking to give them control. So it really is first and foremost about who you're investing with.
So it seems like from an investor standpoint, this process that CrowdStreet itself goes through and vetting them almost to a point that a lot of individual investors probably couldn't get to that level of detail, background checks. And so that is a nice feature. I'm just learning about that myself now, that you're going to do a background check. You're going to ask those tough questions. You're going to try to ask them to be transparent. And is that something that you and your investment team go through at CrowdStreet? I mean, you've had a lot of experience as an operator as well to understand those questions and know what to ask those people.
The answer is yes. We are going to conduct that analysis on behalf of the investor. We will explain what we do and what we don't do, and make that process transparent. But yes, ultimately, in order for a sponsor to go live on the marketplace, they have to complete that sponsor background and vetting to our satisfaction. And if they do, they continue on through the process. And if not, well, you never saw them. They simply didn't make it to the marketplace, right? So, yeah. And when we think from a top-down funnel, I mean, keep in mind, for every 20 potential deals that we see out there, it's really one that makes it onto the marketplace. So in this sponsor screening is part of that funnel process, right? And it occurs towards the top. And it's fair to say that disqualification of a sponsor doesn't necessarily or always mean that we found something bad or we think that they're not a good group or so forth. It might just simply mean that group we don't think is really the best fit for the marketplace. Maybe from the perspective of maybe that's a smaller group that's really focused on developing, right? Maybe we loved the opportunity to get to know them because we thought they were fantastic developers. But we also, in order to give them that control in the deal, we need to be comfortable with their ability to manage investors, right? This is a process. There is an investor relations component that is critical to, delivering a good investment experience on the marketplace. Right. So there's just a lot of fit that's going to be sorted out at that process too. So I just bring that out just because, it's not this binary, they're good or they're bad, and then or good people or bad people, and we move on. Fit is really important before getting on to the next step.
That's great. Okay, that's good information. And so let's assume that we have an operator that CrowdStreet's met the CrowdStreet vetting process. I want to go through this sort of some quick commercial property 101, because I think people who are investing 50,000, 100,000, or up to eventually 500,000 in these different deals, sometimes they've invested locally in their own deals and maybe they understand that market. Maybe they've just invested in the stock market and this is totally new. So I'm wondering if on a deal basis, what are some of the things that an investor should be considering not only to see is it a good deal or bad deal, but also just is it a good fit for them as an investor?
Sure. So let's get into that second part of the analysis out of the three, which is the deal screening process. So once we get past sponsorship, then just like any other investor, we are going to put on our investor's hat. So we're going to evaluate that deal as if we were a potential investor coming into, as a large LP. Because in essence, if you think about it, we view ourselves as representing the collective LPs, which is all those investors on the marketplace. And it's at that point that we're going to pick up that deal. We're going to assign it to members of our team who are steeped in experience in acquisitions and developments by background. And we are going to analyze and stress all the assumptions, right? What are we doing? Where are we doing it? What are we assuming that we are doing to get there, right? In terms of rent rates, occupancy rates, how are we going to improve a property? What are we spending to improve it? What do we think that will translate to in terms of bumps in rents, right? And so forth. Everything, as you know, as being an operator, there are countless assumptions that go into a pro forma. it can take in 30 seconds, you can make a horrible deal look perfect. All you have to do is just rip some rent growth, take your operating expenses down, crush a cap rate, and like you can get to a 20 plus IRR like really fast, right? Maybe that deal would barely break even, but I can show you a model that makes it look like it was the best deal ever envisioned. So it's that process that we have to go through. We have to pressure test all of these things, right? We have to get comfortable with all of the assumptions. We are doing that through a combination of a number of factors. Interviews with the sponsor. What are you seeing? What are you thinking? Why are you thinking these things? We then take that information back in-house. We compare that against our own data sources. We license RCA and CoStar and Green Street and other sources of information, right? We have access to good third-party proprietary data. Many instances, if the group is bringing us a deal, we have either done a deal that looks like their deal, or we have evaluated a deal that looks like their deal in that same submarket. So we can draw upon that history of saying, do you really think you're going to grow rents at the rate you think? Because I have a deal in my portfolio that's growing rents, but not at the rate that you're saying. And by the way, they had to just budget for concessions starting this month. So it's just that type of analysis that you have to go through to get comfortable with what are we doing? Do we think that the targeted returns are achievable? At the end of that analysis, in that second step, we are seeking to look to a business plan that we ultimately believe has a better probability of outperforming than underperforming. Because this targeted IRR and target equity multiple, it's just one data point on a spectrum of possible outcomes. Whether or not we achieve that targeted IRR or equity multiple, well, ultimately, what actually happens is going to drive that outcome. It could look like a better return, a worse return, a shorter term hold, a longer term hold. So getting to comfortability and getting on board with that deal really boils down to getting comfortable with the underlying assumptions that go into that deal, knowing that in reality, it will probably be different than what is on the paper. But are the odds of it being better than the odds of it being worse, right? That's what we're looking for, right? We have to think about it in probabilistic terms because that is what we are doing in a model, right? We are assessing probabilities to everything. Some things you know, a lot of things you don't know. You got to put conservative assumptions in the things that you don't.
Great. So I'm kind of reviewing in my own head what we've gone through here. There's a layer of analysis of the operator themselves. There's a layer of analysis of the deal, the assumptions, the numbers, how likely, how probable is this going to happen. And another thing I really appreciated just my study of CrowdStreet is the idea that y'all have your own thesis of what's going on in the market. You're up to date on just, hey, I think these are some trends long term that are really happening, and you layer that on top as well. And I was hoping, Ian, you could speak some to your ideas that you've talked a lot about on your website of the 18-hour city and the trends of where things are going. Because one of the benefits you mentioned earlier was that an individual investor can diversify among different markets. So if I'm in Clemson, South Carolina, I need to diversify my geography a little bit. So would you mind speaking a little bit about how you see the bigger picture of geography and real estate and how that's affecting some of the deals you see on the marketplace?
Absolutely. Happy to do so. So to take it from the top, what we are ultimately seeking and what we believe, and part of our fundamental overarching investment thesis, is that we are looking for net increase in underlying demand for that type of commercial real estate in the location that we're doing it in the future relative to where it sits today, right? There's just something, there's different philosophies out there. I've met investors who say, I go for cash flow and that's all I care about. But what I want to see is a future that looks better than the past. If the population is growing, if job growth is occurring in that location, if properties are being enhanced and markets and blocks are starting to look better than they did in the past, that to me is a telltale sign that this market is generally speaking going in the right direction, that investing in that locale makes sense, and that we have, again, going back to that probabilistic analysis, that if we're assuming growth, I want to look for where I see growth occurring. And really important, I think that growth is sustainable in the future. So now let's pair that with, kind of an 18 market and, theory. We've been long-term proponents at CrowdStreet of what we call kind of growing secondary markets or 18-hour cities for a number of years. These are cities that are kind of pairing affordability with quality of life. And when you have relative affordability to more expensive locations, while at the same time, you have a rapidly improving quality of life, we think that there's something special there. And we want to be a part of that, real estate landscape going forward. And some of this draws up to like really just kind of big picture stuff. If we think 30 or 40 or 50 years ago, having, access to amenities and good food and a good airport, those were only like a handful of cities around the country. These were the big markets, right? If you weren't in San Francisco or Los Angeles or Chicago, New York, Boston, right? These are the types of places that you had to be in order to get all of those things in one location. And then what happened is that over the course of the last 30 or 40 years, we started to see some other markets start to grow, some things being, coming to those markets. And then to the point now where in the recent years, in the last, 10 or 15 years, better education coming in, right? Like up and coming universities. These are all things that go into that analysis to the point where it says like to today, and this is something that's been definitely accelerated during COVID, right? Where you need to live today in order to have the best opportunities for a good life don't exactly look where and don't have the same requirements that they had maybe 20 or 30 or 40 years ago. And real estate is a long-term spectrum thing, right? Yes, markets move in a course of a decade, 5 years or so, even so. But there's also an overarching long-term trend of real estate where to say that if certain markets are going in the right direction, is Nashville fully priced out for the future of where it's going to be? We can argue and debate whether or not that market is fully priced for how it sits today and maybe for the next few years. Of course, there's pros and cons. But when you start to think long-term, 10, 15 years down the road, it's hard to argue that Austin isn't a great place because that the trends that are occurring there right now, they look sustainable. I don't think fewer companies are going to stop residing there that are coming today. Austin, the same thing. What's happening in Austin is going to have long-term effects in that market. We might be wrong in the short term, but we think that there's good things that are happening that will show up and materialize in the long term. And that net, we want to be where long-term demand is forming. Conversely, we don't want to be on the opposite side of long-term demand and justify why we might go into a certain market because there's certain market aspects there that might look like high cash flow, which equals high cap rates, which might equal, hey, invest in this asset because there's a good reason to invest in this asset. But if it is surrounded by a submarket that is declining in population, that is seeing jobs vacate rather than come to it, we're much less interested in that deal. You might make money in that deal, but making money in that deal might have to do with something very, very specific to it. So sure, in a one-off case, but generally speaking, when we think about these markets, we're looking for long-term net sustainable increases in demand to drive values over time and be invested in the markets that when you look back 10 years later, you love the opportunity where you got in.
I think a lot of people can relate to this idea. Even we're talking on a large scale, picking cities that have tailwinds and that have long-term trends that are going their way. But I know me personally, I've made some of my worst deals I did in my first 5 years were chasing kind of the fool's gold of, that location, micro location within my town is incredible cash flow. Let me go get that C- D+ property, and then all of a sudden I buy that property and there's drugs being dealt next door. And there's, that pro forma that the spreadsheet that I put together in the very beginning doesn't look like that I thought it would 5 years later. And so I think what happens on a micro scale is what I'm hearing you explain on the national scale too, is that you have to pick markets that we can do all we want to on the assumptions and the numbers and the spreadsheets. But if we don't have this kind of macro thesis and it's not generally correct, then those numbers can evaporate. Like we can throw those out the window. At least that's my experience.
Yeah. Or know that, you're going in with headwinds, right? So to your point, I love tailwinds more than headwinds. So it's not to say that you can't make money in a headwind scenario, but when we can find a deal that has great fundamentals, good underwriting, great group, and it's in a location where we think that there's net tailwinds, to me, that's the most interesting scenario, right? Highest probability of success.
Well, this has been very informative just to learn about the basics of how you buy commercial real estate on a platform like CrowdStreet, what the kind of big picture thesis is. I want to wrap this up just by going back to a lot of our listeners are going to be putting their own portfolios together. That's one of the changes of today, is that we have DIY investors who are saying, I think I can pick and choose where I'm going to put my money. And particularly a lot of them are trying to put together a portfolio that they can replace their job income, that they've been working at a job, they're retiring early, maybe in their 30s, 40s, 50s. And so I was just curious, from your standpoint, as someone who's invested personally, helping people do this through the CrowdStreet platform, any recommendations on, and I'm going to have to give you a scenario to kind of pinpoint this a little bit, but someone who is in their 50s, they're not going to go all in on real estate, but they have some stocks and equity investments over here. How can this investing through commercial real estate help them with that more specific of, I need to get some income plus growth over the next 5 and 10 years to replace my job? Do you have any thoughts on that, kind of that type of investing?
Sure. I think there's two different types of scenarios that we see from that demographic of investor coming to the marketplace every day. I'll kind of take it in reverse order. So the first is, I have a portfolio that looks like predominantly equities, maybe a little bit of fixed income in there, but it's a heavy equity portfolio, and I'm seeking diversification. We definitely do lean into the philosophy that a diversified portfolio makes sense. And commercial real estate is the single largest alternative investment class. It's how endowments have made tremendous returns sustainably over decades. So why wouldn't you invest in commercial real estate as an alternative investment class? I mean, that's just our fundamental philosophy going in. So our mission is to basically bring the best equivalent of what we can find out there of major institutional quality deals. We are trying to bring individual investment deals to investors at price points that enable them to layer into them from a portfolio allocation strategy. Of course, commercial real estate should not be 100% of your portfolio. We can all agree on that. So within that spectrum, that's where we operate. And so our job is to bring those best deals that can translate into private equity commercial returns. Private's a really important part of that too, right? There is a thing called liquidity premium. And what you give up by going into a deal on CrowdStreet is that mark-to-market liquidity and ability to exit with a click of a button, right? You do not get that on CrowdStreet. In exchange, you get returns that are targeted to be higher than where they would trade if they were publicly listed. Because if they would get bid up. That liquidity would translate into a premium. And we've seen this phenomenon when it comes to private companies that have now listed public portfolios. Just look at Invitation Homes. Did the real estate magically appreciate overnight? Probably not. But what happened was the liquidity that was previously absent was brought to that portfolio and able to be marked to market and traded daily. So by giving that up, you are long-term layering into higher targeted returns, but you have to be willing to give up the liquidity to get there.
Yeah, I think that's a great point. I always try to talk about that with direct investments as well, is that there's the liquidity. The liquidity is certainly something we all want with our investments, but with real estate, you're not only getting some of those higher returns because you're locking it in, like you're saying. I've also found just the behavioral side of things that, I forget which study it was, but showed that even the typical 401k investor who invested in a mutual fund didn't often get the return that their mutual fund got because they were always in and out. And so another benefit of what you're saying is that you're forced to stay the course on your thesis. You're forced to stay the course on what you've decided up front, and you can't jump out at the first moment that things look hairy or different than what you thought they were going to be. That's how you get to your returns, is when you're patient and when you stay the course.
When markets get a little bit choppy. Absolutely.
Yeah.
Finally, the other profile that we see is the investor who has maybe owned smaller forms of single family residential or commercial real estate, right? They might have a portfolio of 5 homes that they own, and they're deciding that it's time for them to liquidate 2 or 3 of them and then diversify those proceeds into passive investments, right? That is that scenario where their criteria is really 2 things that stand out. First, I don't want to manage this real estate directly anymore. I'm tired of getting the midnight calls, right? When things break. Single family residential, its highest value is probably going to be its vacant state, because you basically spruce it up and you sell it to an owner occupier. You get your highest market clearing price. It's at that point that they want to peel that off. And what's important, the second criteria is these are investors that are starting to see cash flow. Cash flow in single family rentals, for those of us who have owned and operated them, we know that it can be somewhat elusive, right? That roof wiped out 3 or 4 years of your cash flow. If something major happened in the property, same thing. So it's a great way to earn equity multiples. Don't get me wrong. Like, I've made great money in single family. I see investors make great money in single family, but you're making it probably mostly on a going in and going out basis. And they're looking to exit that house, pull out their equity, and then say, is there a place that I can get 5, 6, 7% yield on an annual basis in a passive format? And you can do that at CrowdStreet, right? Actually, our portfolio right now it is looking like right now about an average of about a 6 yield. So that's a lot better than public REITs, right? Which are yielding 3%. It's not as high as 10. Sometimes there are certain deals that can get up to single digits, but investors are saying, I love that 6% yield. I can't get it in my current portfolio of real estate. So I'm going to exit. I'm going to take some gains. I'm going to realize some gains. I'm going to invest the net proceeds and then go to a passive, more cash flow oriented, investment thesis over the coming years. So those are the things that we see on the marketplace, which is why we see some relevance from different types of investors.
Yeah. And I love that control of the types of deals. You can dictate the types of deals you get into, you can dictate the locations, but ultimately it comes back to your personal portfolio and saying, this is what I need at this point in my life. This is the type of deal that'll make sense for me. And you're just giving people that kind of control. Just like any marketplace, saying here are some options, here's some availability. We've done our homework on it. You choose the one that makes the most sense for you and that accomplishes your personal goals at this point.
Absolutely. That choice is powerful. We see certain investors who come onto the marketplace and are looking for equity multiple pops. So they're going to go into things like ground up development. They're willing to take risk. And they say, I understand this is high risk capital, but I am looking to double my money over the next 4 years, for example, right? And I'll take the risk to get it. And I don't care about cash flow in between. I'm going to put in $1 and hope I get $2 back. We have other investors, like I just described, who are now saying, I'm willing to take lower returns. I would love to see double-digit returns, but maybe a 12%, 13% annualized rate of return. The beauty is, as an investor, you can pick and choose. You can assemble the types of deals that make the most sense for you. We're going to do over 100 deals this year. We'll do probably closer to 150 deals next year. So there's that cadence of deal flow coming to the marketplace. And that's what I really always talk about with investors. Don't get overly concerned about this current deal in the marketplace. The equity is finite. Oftentimes, good deals get oversubscribed. That's what's going to continue to happen. But know that you're going to get more and more looks and more opportunities to get to deal flow. And the next deal in the marketplace, it's probably going to be as good or better than the previous one, right? We are generally kind of going in the right direction in terms of quality of deal flow. So over the time, the trend looks good. So don't get overly concerned about that first deal. You thought that might have been the perfect deal, but there's going to be another one around the corner. And maybe that one actually looks better than what you think you're looking at today.
Yeah, this has been really helpful. Really appreciate your time sharing all of your knowledge and your wisdom on this. I know a lot of investors are going to want to follow up with you and check out CrowdStreet. So I was just hoping you could kind of pass on some information about how they can do that and stay in touch with you.
First, easiest way is to check out the website, www.crowdstreet.com. There's a host of information on that website regarding, how CrowdStreet works, what we look for, education behind CRE investing, and then going straight to the marketplace to see live deals being funded today.
Great. Well, I will put links to all of that in the show notes today. And I just want to highly recommend your educational material too. As someone who's been learning more about the broader commercial real estate market, some of the things we talked about today, like the 18-hour cities, just a wealth of information there. So thank you for putting that together, and also recommend your book too, for those of you who are looking to learn more about the fundamentals of commercial real estate, because that's really what it comes down to. Anything we get into, you got to be educated and learn first so you can have the confidence to take action. But really appreciate your time, Ian, and hope to continue the conversation in the future and to see what else is going on with CrowdStreet.
Absolutely. Chad, it was my pleasure to come on the podcast today. Look forward to continuing the conversation in the future.
Great. Thanks, Ian.
Thank you.
If you'd like more details on today's guest or the resources that we discussed, you can find a link to the show notes for today's episode in the podcast description in your favorite podcast player or in the video description on YouTube. And if you're new here, please consider hitting the subscription button on your favorite podcast player or on YouTube so that you'll be notified each Monday morning of the newest episode. And if you like the show, there are a few different ways you can support me to help get the message out in front of more people. The first is to leave a review on Apple Podcast. People read those reviews when they're deciding to listen, and it helps us to get discovered. The second thing is you can subscribe to my email newsletter at coachcarson.com/REI toolkit. New subscribers get my real estate investing toolkit, which includes things like a closing checklist, a deal worksheet, a tenant screening criteria checklist, all of which I use in my own business, and you get those for free. And then there's other goodies that'll help you on your journey to financial independence using real estate. The third thing you can do to support the show is to consider joining one of my online courses, which is where I personally teach and provide tools for you to become a successful real estate investor. You can find out about my evergreen courses, which are available all year long, and I also have a premier course called Real Estate Deal School, which I teach in the spring and the fall, where I help you step by step to buy your next deal. You can find the details on all those courses at coachcarson.com/courses. I also want to take this time to thank some people behind the scenes who make this podcast possible. This includes my podcast editor extraordinaire, Michael Wynn, my amazing virtual assistant, Megan Thompson, my wife, Carrie, who's my partner here at Coach Carson and helps with all sorts of things behind the scenes, including bookkeeping. And then, of course, thank you to all of you, the listeners of this show. This show exists because of you. It exists for you, and I really appreciate you being here to listen to another episode. Everything I've shared with you in this episode has been for general education purposes. I've not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, real estate, and/or a legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and I'm your host for the Real Estate and Financial Independence podcast, which is all about helping you get out of the financial grind so you can do more of what matters. See you next time.